The yield curve, sometimes also known as the term structure of interest rates, has become of greater interest now that interest rates are very low and perhaps poised to rise again, along with recent activities on the part of the U.S. Treasury. Here's a 90-year graph of short-term, intermediate-term, and long-term interest rates in the United States. And here's a some 40-year retrospective, which gives a little bit more detail. And you do notice that sometimes the longer-term rates can be lower than the short-term rates. And as we will see, often, usually, the short-term rates are usually lower than long-term. And here's a graph of various international rates of various countries, showing the lockstep relationship of the new world market since the turn of the millennium, the last dozen years. It's at this place where I like my students to pretend they're in a world where there's no inflation, zero interest rates, no chance of default because it's insured by the bank of Dr. C. And would they prefer to borrow or lend in this interest rate free, zero inflation, zero interest rate world? Now, let's pause and think about that. Let's see, in this world, you can live in this beautiful mansion, buy a new car, take trips, make your friends envious, or you could loan the money to somebody else. And is thus it yours or mine to enjoy now or later? Well, a guy named Irving Fisher posed much the same thing and posited the idea of the real rate of return, wherein if prices, inflation, here I'm going to call it P, were zero, you'd still charge a premium to lend it to someone else. So you're not enjoying it, but they are now. Or you'd be willing to pay that rate of return, here are, maybe 2-4%, depending on age, income, wealth, whether you're Dutch or Scottish. So you could consume now instead of someone else. And the idea of a zero inflation rate's not too far-fetched. It occurred in the late 1930s in the U.S., not so recently as well, and in Japan. We can also look at other circumstances. Consider an example, not too far-fetched, when Reagan was president. Well, there he goes again. Interest rates, here I'm labeled at I, were 18%. And the inflation rate was 21%. And watch it, the real rate of return was a negative 3%. In that case, you'd probably prefer to own stuff, you know, land, collectibles, gold, instead of paper, financial instruments. And we can compare that to perhaps a period of time under Jimmy Carter, where interest rates did indeed fall to, say, 10%, but inflation fell faster to 6% with a nice, healthy 4% rate of return if you view it in real terms. And there you'd prefer to hold financial instruments, paper, over real assets. And that means that the real rate of return kind of is a partial predictor of interest rates based upon inflation. And the expected rates of future inflation and interest rates can be subject to expectations, which we can infer, sometimes called the forward rate of return. In this simplified, stylized example, I've considered perhaps a rate of return from now, period 0, through year 5 at 7%. And for 5 years, I know, not compounded, we'll deal with it, would give us, say, 35% across the 5 years. And then 2 years at 4%, that'd give us 8%. So the remaining 3 years, by just simple arithmetic, must have meant a 27% total, or 9% per year. And a thumbnail arithmetic rule would be to take this unobserved inferred forward rate let's say in years being here 5 and m years here being 2, giving us 3, and finding out what the remainder is when we found out there was in years, that's 5 at 7, minus 2 years, that's m at 4, and the difference was 27, and we divided by 3, getting us 9%. Or more accurately, we could take the geometric compounded rates of return, here taking the cubic root of the ratio of the total compounded returns for the 5 years compounded at 7%, divided by the square of the compounded returns for the 2 years, and that would give us the rate of return. And of course that's for the total return, so we would subtract 1 to get the forward or inferred rate of return. Here's some more conventional notation, noticing again we can multiply, take the product, that's what this capital pi here is doing in this case, and figure out the return in terms of the roots, and the arithmetic is just an approximation which doesn't do too bad of a job in short periods at low rates. And thus one might conclude, wrongly, that if inflation was to be expected to be steady, then interest rates might be flat or maybe rising if you expected there to be an increase in inflation, or falling if vice versa. And that would be wrong, and moreover, we often don't always observe that. Although, as we will see, it is often rising, but for a different reason. Consider, if you will, the interest rate risk of debt instruments, which we looked at previously with regard to bond duration and immunization. And one should recall that generally longer maturities have greater interest rate risk, but not always. See that hump there when high discount rates are applied to low coupon rates? In fact, we observed that back in the 70s and 80s for the same reason we see it here, but we're not there yet. And keeping in mind the graph we just looked at, there's less interest rate risk to bond buyers, who are lenders of funds. So generally speaking, they prefer to be on the short end of the yield curve. By the way, did you notice the graph here does not go 1-15-30, but goes 1-5-30? Because if you, yeah, I know, you can take your videotape and go back. The half the risk to, say, a 30-year bond is around actually 5 years. We call those intermediate bonds. Now, on the other hand, the borrowers, the seller of bonds, this may not be obvious at first. If they went short-term, rates could rise or fall. They'd either be ahead or behind. On the other hand, let's suppose they go long-term. Let's see, if rates rise, they don't want to do a thing. They say, good for me, I locked them in long-term. But if rates fall, then they get an asymmetric advantage both ways, because if rates fall, they get to refinance at a lower rate. So borrowers, bond sellers, prefer to go long-term because they either win or win. So we thus have a natural inclination to normally have a yield curve that is bent upward, wherein the buyers prefer to be short-term, they bid prices up, yields fall, okay, and sellers, the persons borrowing money, prefer to be long-term, price goes down, yields go up, and we're going to add this to the underlying expectations of inflation from the Fisher equation to expected interest rates, and that's where the fun begins. And this preference for investors, buyers, lenders of bonds, to be short-term, a liquidity preference, if you will, after Sir John Hicks, is never directly observed. We only observe the total effects of the expectations of interest rates from expected inflation, plus the liquidity preference to be shorter term, meaning one would demand a higher return to take on more risk, and likewise a borrower would prefer lower interest rates. but doesn't prefer the risk and instead would prefer to go longer term but pay a premium to gain that advantage. And thus, on rare occasions, we observe downward falling curves, expectations of lowering inflation, and sometimes even a hump, which I would argue can be best explained and was observed during time periods of high yields but low coupon rates, just as we see here. But wait, there's more. We have two theories, expectations, liquidity preference. There's a third one, sometimes called market segmentation or preferred habitat. People like maturities that match their usage. It lowers their interest rate risk. And therefore, people who want 5-year money want 5-year money. And that also explains the yield curve with Dr. C.